Markets are heading into one of those rare moments where multiple macro forces collide at the same time. And history shows these are the moments that reset narratives fast. Tomorrow isn't just another day-to-day. It's a stress test for how investors are currently pricing growth, rates, and risk. At 8:30 a.m. ET, the U.S. jobs report will hit a market that is already stretched between optimism and caution. Labor data has become the single most powerful driver of expectations because it directly answers the question everyone cares about right now. Can the economy slow without breaking? A hot report reinforces the idea that demand remains too strong. Inflation risks persist, and interest rates need to stay higher for longer. That pushes rate cuts further out, tightens financial conditions, and forces markets to reprice assets built on easier money. On the other hand, a weaker report does not bring immediate relief. It raises a different concern, that restrictive policy may already be biting harder than expected, pulling recession risk back into focus. Either outcome moves expectations, and expectations move markets. At the same time, a Supreme Court ruling on tariffs looms just hours later, adding a second layer of uncertainty. Tariffs were a major source of volatility last year because they sit at the intersection of inflation, corporate margins, and policy credibility. A ruling against tariffs would immediately reduce friction in the system, improve visibility for earnings, and lower future cost pressures, all broadly supportive for risk assets. When events like this cluster together, markets don't get the luxury of digesting them slowly. Positioning, sentiment, and liquidity all come into play at once. This is why tomorrow matters more than it appears on the surface. It's not about one data point or one legal decision. It's about whether the current market narrative can survive a real-world test. What makes this setup especially dangerous is that markets are not positioned for ambiguity. Over the past few weeks, pricing across equities, rates, and crypto has leaned toward a relatively narrow range of outcomes: cooling inflation, gradual growth moderation, and eventual policy easing. When expectations become that concentrated, even neutral data can feel disruptive. If the jobs report comes in stronger than expected, it doesn't just delay rate cuts. It forces a reassessment of how restrictive policy truly is and how long capital will remain expensive. That repricing hits duration-sensitive assets first, pressures valuations, and tightens liquidity across the system. If the data comes in weak, the market doesn't immediately celebrate either. Instead, attention shifts to whether the slowdown is orderly or accelerating, and whether earnings and credit conditions can hold up under higher for longer rates. Layer on the tariff ruling, and the complexity increases. Trade policy directly affects input costs, margins, and supply chains, but it also shapes confidence. Removing tariffs reduces friction quickly, even if alternative tools exist, because it simplifies the outlook for businesses and investors. Markets care deeply about visibility. When visibility improves, risk premiums compress. When it deteriorates, volatility rises. Tomorrow's events compress that adjustment into a very short window. That's why reactions may look outsized relative to the headlines. This isn't about overreaction. It's about markets being forced to update assumptions that have quietly supported prices. When that happens, moves tend to be fast, cross-asset, and unforgiving to crowded positions. Another critical aspect today that holds importance is how swiftly signals can propagate across various asset classes when the narrative starts shifting. Initially, rates move at the forefront, followed by currencies and finally, equities. However, as the dynamics progress, it becomes increasingly evident that cryptocurrencies are significantly reflecting changes in macroeconomic stress in real time. If yields experienced a significant surge after the jobs data, the dollar strengthens, resulting in an increase in liquidity and a rise in market stress for risk assets as well. Conversely, if yields saw a sharp decrease following weak data, the initial relief might rapidly give way to deeper concerns about the growth, durability, and earnings resilience of equities. Cryptocurrencies often react before equity indices fully process the underlying changes, and this is not because they are detached from fundamentals, but rather because they function as continuous market participants that respond efficiently to shifts in risk appetite. The introduction of tariffs into this mix only heightens the feedback loop and amplifies the rapidity of market responses. Trade policy has a notable impact on inflation expectations, which in turn can lead to alterations in rates and affect valuation metrics. When multiple interconnected levers are employed simultaneously, markets don't undergo a period of waiting for confirmation. They front-run outcomes almost instinctively. This is very much why days like tomorrow carry the potential for significant fluctuations in the market, rather than merely producing volatility. They play a crucial role in determining whether recent positioning remains relevant or whether capital needs to be swiftly reoriented for the different narrative that emerges. Ultimately, for traders and investors alike, the main concern isn't the possibility of missing a volatile move, but rather being positioned in a situation where the narrative has shifted, but the existing framework's narrative hasn't. What investors should be paying close attention to is not only the initial reaction it generates, but also what lies behind and what does not continue once the situation has settled. Big macro days frequently bring about sharp and noticeable initial moves, but it is the ones that follow through that truly signal the real change. If the markets experience an initial surge or acceleration of a decline after reassessing the data and drawing conclusions, it signals that the investor's conviction is shifting, not merely varying in sentiment. This is particularly crucial in a market environment where liquidity is scarce and positioning is tighter and more critical than it appears at first instance. When narratives collide and the opinions of the weak hands are forced out, while the stronger trends make an appearance, assets that manage to withstand the initial volatility and signals of confidence are more likely to fare better in the long term. Conversely, those that do not manage to do so would likely end up experiencing significant stress. This crucial distinction is of great importance because it substantially shapes investors' behavior throughout the week and sometimes even surpasses that effect. Understanding the significance of this day, tomorrow isn't solely about testing the data or policy at hand. It is also about verifying whether the current market framework has the ability to adapt and absorb new information without it collapsing. When the market proves capable of doing so, the volatility will be absorbed and trends will achieve stability. If the market cannot adjust without causing disarray, the complex search for a new equilibrium will ensue. This is why experienced investors tend to approach these kind of days with a sense of caution and profound focus. The primary objective isn't in trying to predict the eventual outcome, but rather in recognizing when the in itself is indicating a significant change has occurred. The bottom line is that tomorrow forces clarity in a market that has been consistently comfortable with the assumptions and lack of innovation. Jobs data will be the key determinant in testing the growth versus rates balance in order to understand how the system operates. Simultaneously, the Supreme Court's tariff decision will provide a test to determine how much policy friction the system can sustain, as well as the potential to reintroduce it at once. Together, these factors create a challenging situation where expectations are continuously reset in real time. For the markets, this is where momentum can shift. Leadership can change, and volatility can either expand or collapse. Regardless of the outcome, one thing is certain. All these changes can either provide an opportune moment for investment or lead to significant market instability. In the context of crypto, which tends to exhibit a stronger response when macro narratives collide, the reaction might hint at how risk appetite is genuinely shifting. While this doesn't guarantee a particular direction, it can potentially offer an early signal of how capital is allocated in the market and, more importantly, how risk-oriented investors might become. In conclusion, tomorrow is not just another standard trading day. It's a pivotal moment for the market's current story and a way to identify potential vulnerabilities and how to adapt to them. By staying vigilant and being prepared for potential changes, you can minimize the risk of missing crucial opportunities and better understand how to navigate a rapidly evolving and dynamic market landscape.